See if you see it.
Hey everyone.
Hey, Marshall.
Oh, hey, there's my picture.
Wow,
Yeah, there we go.
that's a nice picture, Chris.
Oh, it's because I'm on my personal phone, the picture pops up as opposed to when I'm on
Okay.
my name.
Okay, we got a couple more people coming in, so let me let them in, but we are live. We want to get started.
Okay. Thanks everyone for joining today, January 18th, for the investment meeting for the St. Louis Public School Teachers Retirement System. Sue, can I get a roll call vote for attendance, please?
Angie Banks,
Here.
Christina Bennett,
Present.
Louis Cross,
Present.
Sheila Goodwin, Emily Hubbard,
Present.
Shanice Johnson,
I'm here.
Yvette Levy, Martell Mann,
Present.
Bobby Richardson. She's still connecting. Albert Sanders,
Present.
Doris Walker, Bobby Richardson.
Did she hear you?
It's like
Bobby,
she's-
did you hear us?
It's like she's trying to connect.
Okay, still connecting.
Okay.
Okay.
All right. Well, we have, so even without Bobby, we do have 7, so we do have enough for a quorum, so.
Okay.
Thanks everyone. We're going to quickly proceed to our 2 presenters that we have online today for PNC to discuss the integration. And then we'll hand it back over to Jeff to go ahead and give us a review of the portfolio.
All right. So yeah, we have PNC coming in right now. And Bobby, can you hear
okay.
us?
Doesn't look like it.
Yes. Hello, everybody.
Hello, Bobby.
Okay.
All right. We got one more trustee coming in. Theodora, good evening.
Hi, Sue. How are you?
Good. It's good to see you. And I think we have Ken.
We do.
From
We
PNC.
do.
That's the 2 team members from PNC. So I don't know, Jeff, if you have any intro comments before we turn it over to PNC.
Sure. So, and just for refreshing everyone's memory, and also for the benefit of Emily, now a new trustee. So the system recently went through a very extensive process of an RFP for a custodian. It's a process that's been that hasn't happened in a while, and so certainly from a standpoint of good fiduciary governance was a very good process to go through, and that ultimately resulted in the committee and the full board approving and selecting PNC to be the new systems custodian. So with that, there's been a lot of moving pieces in the background and stuff that Sue deals with on a daily basis. Gwelda and I are essentially dealing with on a daily basis as well. But ultimately the objective was to have this up and running and transitioned at Jan 1, and certainly there's it's something of this magnitude with a lot of moving pieces, size, scope, lots of different investment managers, accounts, and other things involved, that there can always be hitches and things that happen here. So in any event, it's again, we wanted to have the opportunity for PNC just to provide an update of where we've been since the process has started, where we're at today, and just what else is currently outstanding before this process is complete. So with that, I'll hand it over to the folks at PNC.
Good evening, everyone. My name is Theodora Washington, as Sue so eloquently introduced me prior. I am the custody relationship for the system at PNC. Along with me is Ken Duncan. He's in charge of our asset servicing team. We just wanted to give you a brief synopsis of everything that's been going on. To Jeff's point, this is an account of great magnitude, so there have been a lot of moving parts. So I'll just try to keep it just as simplified as possible. Okay, Ken said he's having audio issues. Okay, so as of today, we have successfully transitioned 86% of the assets from US Bank to PNC. There were some residual positions that were held at US Bank because there were some pending trades at US Bank. So until those trades settled, they wouldn't be able to release those assets to PNC. We anticipate getting those positions in by Monday. I know I don't work on this side of the bank for your treasury management needs. However, I am aware that the transition for that side of the business also went through successfully. Sue's already been in contact with the relationship manager for the treasury management side, already acquired checks. So we're good to go as far as that's concerned. We have diligently worked with Sue and Terry. Also, as Jeff mentioned, working with Jeff and Guelda with ANCO, as well as your investment managers, to try to make this as smooth as transition as possible. We have provided training for Sue and Terry on the custody side, as well as on the retail side for our internal systems. So we can kind of attempt to make this a better system for her to work in, because things are more automated. So she doesn't have to like go through and talk to 9 different people just to get a process done. She's able to actually go in the system and get it done on her own. That's pretty much a brief overview. Did you have any questions, concerns, or comments about anything before we kind of
Theodore, just for the benefit of the trustees to understand, so we were previously at US Bank. They were doing the safekeeping of the assets. PNC's responsibility now is the safekeeping of those same assets, but in the transition, so there's still some things at US Bank, but mostly everything is at PNC. But I guess from the standpoint of, since we're still sort of dealing with 2 banks, everything is accounted for, all assets are there, nothing's gone missing, we're whole, correct?
We are whole. So we have been working with your investment managers and having them ensure that we match exactly what they have in their systems. We have been, I know this is probably a little bit too much in the weeds, but we've been updating costs and making sure that we reconcile back to those investment manager statements. So we are whole as far as that's concerned. Any pending trades that were outstanding at US Bank, we've been working with US Bank to make sure that we get those assets captured, make sure that we have the right assets transferred over to PNC once those trades have settled.
Great. And again, the reason I bring it up is I just want to make sure that the trustees know that, again, there's a lot of moving pieces. Oh, I'm sorry. I'm not muted. With a lot of moving pieces behind the scenes that, ultimately, I think the goal of everybody that's kind of working on this to make it happen is to make it seamless and to make sure that, you all, when you see our report and all the asset values and things in there, that, you're not going to be seeing reports from a bunch of different custodians, things like that. You're still going to see everything as the same sort of line items you've always seen in our reports. And again, most importantly, you shouldn't see any gaps in asset values because everything's there. Everything's accounted for. So.
Question. Can you hear me?
Yes, ma'am.
Yes.
Okay.
Sheila.
About how long will this process take, the reconciliation and finalizing with US Bank and not leaving anything with them? How long approximately will that process take?
For your domestic assets, we anticipate that being transitioned over no later than Monday. We did have some foreign ordinaries where there are some what we call segregated markets, which is outside of the traditional markets that the United States does business with. So those accounts will be held at US Bank until we get those additional market accounts open. And we're anticipating worst case scenario a month, but we're pushing for that to happen by the end of this month.
Okay, thank you.
You're welcome.
We shouldn't have any hiccups with that then, right? And do you have any anticipated hiccups?
No, ma'am, I'm not anticipating any hiccups. I'm definitely keeping Jeff, Gwelda, and Sue in the loop in the event that anything does just happen to pop up. But we do diligently work to get it resolved so that it does not become an issue for the system.
Okay, great.
And we do have weekly touch base calls with Theodora and Jeff and all the parties involved. We even had US Bank on a few of those calls as things were being transitioned. So a lot of communication.
Oh, that's great. That's wonderful. Mm-hmm. Louis, you got any questions?
Not at this point. No, she kind of covered a lot of those things, but that was a very good point to bring up, Sheila.
Okay. Mm-hmm. All right. All right, Jeff, anything else you want to share with us?
I think that's it. Again, it's from your standpoint, if we were kind of to walk you through everything that was going on a day-to-day basis, I think everyone's eyes might kind of glaze over. But again, that's kind of why we have these weekly calls, and even outside of weekly calls, there's a lot of emails going around. And again, the ultimate goal is just to make sure that everything is tracked, that all the assets are there, they're safe, whether they're at PNC or whether they're at US Bank, that they continue to be safe. They're not going anywhere. It might, some of us might have some heartburn trying to do some reconciliations and get things there, but ultimately they will be reconciled. So for any reporting that you all need to see to make your decisions, it'll be there. Again, all of that should look the same, and kind of let us behind the scenes scramble and make sure it gets there. So
great.
And if I may just piggyback, I'm sorry, if I may just piggyback on what Jeff just said, just to kind of put you all mind at rest. We also do have quite a few internal partners who's also working and diligently reconciling all of those assets as they come through. So as soon as we start getting things through our transition system from US Bank, we start reconciling those ASAP as soon as they hit our books, just to make sure they tie back to those investment manager statements. So there wouldn't be any miscounting of anything like that. If we notice that there's a discrepancy, we go right back to US Bank and to that investment manager to clear up that discrepancy.
Oh, thank you all so much. Seems like you are got a plan. Keep it going.
Thank you so much.
Mm-hmm.
Thank you. Sorry I could make it on right away, but I appreciate you allowing me to be here.
Welcome.
Mm-hmm.
Well, thank you both, Theodora and Ken, for joining us this evening. I know, Theodora, you're an hour ahead of us, so appreciate you joining us tonight.
Absolutely, not a problem at all. And Ken and I are in the same time zone, so the only difference is I'm cold and he's warm. So
yeah. Don't rub it in. Don't rub it in.
I'm in Southwest Florida, so don't feel bad for me staying up late.
Yeah.
Ken, you need a spanking for saying that, Ken.
He's going out on his porch to have a cocktail after this, I'm guessing.
Right.
Right. Mm-hmm.
But Ken and I would like to thank you all for your time and allowing us to be a part of your meeting. We really appreciate it. And again, we appreciate the systems business. We look forward to working with you in the future.
You're welcome, Ms. Washington.
Thank you so much.
No problem.
Good evening, everyone.
Thank you.
Bye-bye.
Thanks. Bye-bye.
What's next?
What's next is Jeff is going to go over the agenda for
Oh,
investments.
hi, Christina.
Hi.
I think you probably just X out at the top right there,
Oh,
Sue.
I was trying to get it. I was trying to get the X to pop up. So there we
Yeah.
go.
Okay, so it looks like we're gonna start with the private market pacing.
If that's what you want to do, we can also do
It's
the,
fine. This, I mean, frankly, this will be really quick with the exception, again, I'm happy to come in and explain things in more detail, but I think everyone with the exception of Emily has seen this before, at least when we did it last year. So Sue, if you want to flip forward to the first page. So next one. So back up one if you can. Perfect. Okay, so this is just despite all of the crazy numbers and graphs and lines and things you see here, the ultimate goal of what we do here with these pacing studies is just to determine how it's really an estimate of how much capital we want to put to work in the private markets every year. And so why we do this, and just to remind everybody that these private markets, whether it's private equity or private debt or real estate, they're a little bit different than when we invest in a mutual fund or an equity separate account. Those folks can put they can put money to work really fast, or they can, if we need money back, they can give it to us pretty quick once we request it. Those are all very liquid securities. This portion of the portfolio works a bit different in that there's not a lot of liquidity there. So when you invest in a private equity manager, that money can be tied up for 10 plus years. And it comes back in dribs and drabs. So they can put money to work into a company, and that can operate for quite a while before any sort of money comes back. Or they can place money with a company and get a home run. Somebody says, we want to buy that company from you at a large price tag, and now all of a sudden you have liquidity. That money comes back. But the fact is, that's with all of these little underlying deals that go on in a private equity or in a private debt portfolio, there's just a lot of uncertainty as far as timing. So this is sort of our attempt to say, estimate how much we think a given deal might give back every year over the next several years. How much, and then how much we have to put to work to offset that. And so that's sort of what the lines represent. So certainly we have a target allocation, which is the red line with the triangle, and then we have a predicted, which is kind of where we want to be, and we want those lines to be on top of each other. But how do we get there? Well, it's those estimated amounts that we want to put to work every year, and so that's the blue bars at the bottom of that top right graph. And so sort of the good news is that over the past couple of years on private equity, we've been pretty active. So as you see, the 2024, 2025 numbers, and then if you look at the table on the bottom, that's just the in number a summary of what we have in the graph above. But you can see only 2 million would have to go to work to sort of keep us on pace. And frankly, that kind of puts us in even if we don't get a private equity deal in the hopper this year, it's not going to throw us off much. So we can certainly look at if there's something that comes to market and it makes sense. We can bring some ideas to the committee, but frankly, this tells us we're pretty good. We're kind of right on our target for private equity right now. So again, we will update this every year because things do change. You could have a deal that gets very liquid, gives us a lot of money back. All of a sudden we're in a position where maybe we start to be a little bit more underweight, but right now we're not there. So that's sort of the good news with private equity. We're on a pretty good schedule for pacing right now. I'll pause and see if there's any questions. Okay, so you want to flip forward one page here? Okay, and this one I'll apologize because up on the top it says private equity, even though it should say private debt. So this is the other private asset class, private debt. So again, recall we had a couple of searches and a placement that we did last year. And as last year's number was up there for what we needed to do in double digits, and as you can see, we're still sort of in that same camp. So we have I'm now focusing on that bottom right table. So 2024 to keep us on pace, we would need to put about 14 million to work this year, 12 million next year, and then about 10 million after that. So here you see we're probably a little bit more work that needs to be done. So we're still well within our policy range. So it's not that we're out of compliance. It's just that for this one, for the past couple of years, there's been a pretty big focus on what we're doing with the real estate portfolio, what we've done with private equity. Again, we started to address the private debt last year, so we're moving in the right direction. And certainly the deal that we finalized last year, as they start to call capital, that's going to play into this commitment number as well too. So once that starts getting drawn down, we should expect to see the 2025, 2026 number be a little bit less. But nonetheless, the private debt is for at least for any private asset classes right now, that's going to be our focus this year. So we have our group right now, our research group, looking to identify one to two potential deals that we can take a look at for sometime before the end of the year. So again, we get that we had a lot going on with the custody with the custody search, and then before that we had that other private debt search that came up. So we've been busy, and you all have been busy taking a look at these things and in approving recommendations too. So again, we got to stay a little bit busy, and so we'll be on top of that. And again, expect over the next couple of quarters that we should be coming back with some thoughts on potential additional private debt managers to keep us on pace here. But again, still in compliance with the policy, but just want to be a little bit more active to kind of get us to that position where you see sort of in the 2026 to 2028 range, where we start to be more in line with that red target line. Questions, comments on private debt? Okay, Sue, if you want to flip forward one more, and then this one's really easy. So this is the real estate. And again, we have been over our target in real estate. Again, no major compliance issues with the overage, but again, just to sort of refresh everyone's memory that we have the allocations to UBS that we have redemptions in for. And so that's certainly going to represent the bulk of the over allocation relative to target. So as we sort of talked about before, I think at length, and we had UBS on with the committee as well to go through this, that this will be a several year process of getting that money back from UBS. So nothing is going to happen fast here, but I think the bottom line is there's really not much to be done search wise to present any additional real estate ideas. And again, recall, in addition to what's been moving with UBS, prior to us coming on, NEPC had a number of other real estate managers that the committee and board approved, and those allocations came on. So that's made us pretty well square for real estate. So should be a while yet, at least until we get a bulk of the UBS assets back before we're in a position where we're thinking about other real estate investments. So hope that helps. Again, this is an annual process, but ultimately the design of this is just to make sure, given uncertainties with cash flows and making sure we're in compliance with policy, that we have an ongoing plan to make sure we're looking at the right spaces and right investments in the private markets. Okay. Should we go to the flash report for December?
Yep, sounds good.
Yes, please.
Okay, so following up on the discussion with PNC and having assets and knowing where assets are, and all of the good news from that is that assets grew very nicely in December, and it's been a while since we've met too. So I think hopefully everybody got a chance to take a look at the November report that came out earlier as well. That was also a good one. So ultimately, when the quarterly report comes out in a few weeks, that you'll see it was a really good quarter. But December was really one of the drivers of that. So Sue, if you want to flip forward page. So this is just a general overview of the markets, just to highlight a few things for the month. That top section of bars, you see the month. So those were the returns for the major equity asset classes in that first segment. So you see the S&P 500. That's the big large cap stocks that everybody hears about and talks about, and we see in the news all the time. Microsoft and Apple and Coca-Cola, all the big ones are in there. So a nice solid month at about 4.5%, and brings the latest 3 months in that index close to 12%. And then for the full year, just shy of 27%. So a really strong year for, if you think about some of the things that we've gone through and the volatility and what the first couple of quarters looked like, and sort of started off the year in doubt of where things were going to go and what ultimately would happen with the Fed and interest rates, and to end up a year with a nice solid double-digit return like that was just a fantastic way to end. So you can see the other areas of the equity markets were equally as strong. So for the month, you see the mid cap right below the S&P 500, and then the Russell 2000. Those are small caps. Those are the smallest ones, the riskier ones, the companies that are kind of up and growing and trying to make their way in the world. Those did really well, 12%. So that's, again, an area of the market that we've had a little bit more of that uncertainty with respect to interest rates and the overall economic situation. Those lagged, but once we now start to get a little bit more clarity, we're seeing some good returns in that realm of the market. So again, from the standpoint of what's driving all of this positive movement, and again, you take a look at that Russell 1000 growth index for the year-to-date period, for the 1 year period, over 40%. So that's driven a lot by a lot of those tech names. Again, there's some overlap in that index and the S&P 500. In particular, when I talked about Apple, Microsoft, some of these other big tech names, just a really good year for a lot of those types of companies. So it's really, the market is happy that the Fed is probably at the end of this interest rate hiking cycle. So that's been really problematic for, again, businesses, as their cost to borrow has gone up. That cuts into the business's bottom line, and consumers certainly. If you jump down to that third segment of boxes on the left where it says key rates, and go down to the second to the last line of that, where you see the mortgage rate, and at almost 7%. And if you go back, last year, at the end of 22, very similar, end of 2021. However, that's a huge difference, and also at the end of 2020, at just shy of 3% on a 30-year mortgage. So those were great mortgages. Those are the things that certainly will fuel a housing boom and a housing market when you can borrow that cheaply. Surprisingly, the housing market, even in the wake of 7%, those much higher interest rates, the housing market's still been pretty strong. Other areas of real estate haven't, the commercial in particular. So if anybody out there owns a strip mall or an office building, those have been hit a lot harder by those higher interest rates, and it's been caused things to be valued more negatively. And again, we've had that office issue from COVID of not everybody has still come back to the office. So that area of the market has been impacted, but that's kind of the negative of where interest rates have been. But for any of you all, and I certainly have some money there too, and just in a money market fund. Well, if you go back a year ago, and again, sort of look at, you go back to the top line of the key rates where it says the U.S. generic 3-month, that's kind of where your average money market fund is going to be yielding. Again, look at the end of 2021, it was flat. You were getting nothing for, if you were in a checking account in your bank, you weren't getting anything, or in a money market account, savings account, not a whole lot. Now it's to the point where you're getting 5+% just to be in a money market. So that's the safest area of the market, and that's a pretty nice return. And good news on that is that the world prices everything off of that base rate. So they say, well, that's what you get paid for not taking any risk. So if we're going to structure a portfolio that has all of these areas, things that take on somewhat more risk than that, if we're going to be in, fixed income that either has a longer maturity or has a little bit more risk in it because of credit, or if we're going to go down the spectrum and be an equity holder. So in our equity portfolio, that's all additional risk relative to that money market fund. We should be getting paid a lot more. So that's how the world prices things. And that's the good news. So 5% is kind of our floor right now. So that really helps us to think about how a portfolio like the system is structured on a go-forward basis, and the assumed rate of return that your actuary uses to value things, and the probability of hitting that assumed return on a go-forward basis has improved quite a bit. So there's a lot to be confident about right now for sort of the medium and long-term returns of the system and meeting objectives, not only relative to benchmarks that we look at, but again, what the actuary is using to calculate all of their assumptions and things that they report for the system. Pause there. If there's any questions about the economy in general, or
Jeff, I want to say, hey Jeff, I want to just make a comment. I think the last time we met, like in October, I saw a lot of negative signs, but now I don't see none. So that means that we are making money, right?
Right, and we'll flip over in a second and sort of put these numbers to work on what the system has actually done. But you're absolutely correct. So Sue, maybe that's a good segue. It's almost like I paid Bobby to ask that question so we could move forward here. But really quick, this is just the asset allocation. I think we've talked quite a bit about that, and then just putting things in perspective from that pacing study. Again, if you look at the bottom 3 lines of that top graph, it's the private equity, private debt. The cash is the bottom line. So the 3 above that, real estate, you see that's a little bit over, but the gray bars, if everybody recalls, those are our allowable ranges by policy. So ideally, you want the triangle, the upside down triangle. Those are the actual figures for each asset class. That black line is where the target is. So that's where we want to be. But then we do have allowable ranges that we rebalance within. So we always want to be within those. And you can see across the board, any asset class, we're within the ranges, and most are pretty close to those center lines. So the core fixed income a bit more underweight, the global multi-sector a bit underweight. These are things that we always address as we do ongoing rebalancing. So when there's cash needed for benefit payments and expenses, we're looking to take it from places that sort of keep us in check there and keep us in balance. But and again, going back to the pacing study, the one on the private side that seems to be the most out of balance is that private debt. Again, we're still within the tolerable range of the policy, but our focus will be to start to move that closer to the line. But again, all of our asset classes are in compliance with the policy ranges right now.
So Jeff, I just want to say all the triangle marks close to the solid line mean we at our targets, but we looking for all those triangles be beyond that solid line, correct?
No. We want the triangles to be on the solid line. So let's use
On
large
the,
cap
on the
equity,
side, okay.
for instance. Large cap equity is pretty much right on its target. So, and again, why do we set things up this way? Why do we have those little vertical lines as targets, and why do we have the range as well? It's because we want to stick to a long-term policy, because we do an asset allocation study that says we think over a very long-term time period that large cap equities will give us let's just say a 9% return, and then small and mid cap will give us a 10-11% return. The internationals 11, 12. I'm making up numbers, but again, this is what we do with an asset allocation study. And then when you start to aggregate all of these different asset classes together, that gives us a total system return that, again, we have an objective for, and that's to meet the actuarial return assumption, which, Sue, that's 7% or 7.25?
7%.
7%. So again, that's the objective. And again, with this page, this is something that we really look at to say, if the markets are really strong like they just were, and they continue to do that, then that triangle, if large cap equities do really well, then that triangle will start moving to the right. Why we don't like to go outside of the gray box is that if we have too much in equity relative to our target, and then all of a sudden we have a bad period, we can lose more than we anticipated. So that's why we don't like to go too far beyond that middle vertical line. And conversely, when you get too far to the left of the line, so again, let's just say equity markets have a bad period and that makes the triangle move to the left. Well, we don't want to go too far left, because now we're underweight. And if the equity markets do extremely well, we missed some of the upside. So that's why we want to rebalance. That's why we ideally want to be on those lines, because that kind of keeps us not losing too much when each one of these asset classes has a bad period, and not missing out when each asset class has a good period.
Okay, thank you.
Does that help, Bobby?
Thank you. Okay, thank you.
Okay,
Someone needs to go on mute
somebody needs to go on mute right away.
right away. All right,
Okay, why don't we flip forward one page, Sue?
thank you.
Okay, Bobby, now to answer your question here, your original question. So these are the numbers. This is the where the rubber meets the road, and you're absolutely correct. If we looked at this same report a few quarters ago, we probably would have seen a lot more negatives, just because of the more challenging year that we had last year and the start of this year that wasn't great. But again, what a difference a couple strong quarters, even a couple strong months, frankly, makes. So really, a lot of this, that strong 1.8 return that we see, a lot of that really came in 2 months, in November and December. So, and again, I think it's important to point that out, because that's from the previous page. That's why we like to rebalance, and that's why we like to stay on target, because the markets can be really lumpy. And if you have, and even if you look at the strong months that we had in November, December, those monthly numbers were really the result of just a couple of days, just a few days within the month. It wasn't a straight line in December. It was choppy, big day, choppy. If you missed those couple of really big days, you miss almost a whole month of return. So again, that's why you'll always hear us talk about being strategic, having a strategic long-term asset allocation, paying attention to that chart that we saw on the previous page, and making sure we rebalance appropriately, so we catch these things, and so we can be in this position. So again, from the standpoint, it was a really good month. You can see top line almost 4%. Brings that fiscal year to date number up to just about 11.6%. The full 1 year number, up to 11.6%. The 3 year number, again, still kind of feeling the major impact from last year. So that's still going to be below The target, the 5-year number is going to be well above the target that we're at, and then the 10-year still is still going to fall short of that. But again, the inception number that you say there gets closer to that 7%. And again, the longer term we take a look at the numbers, and certainly as we forecast out and look forward with where things are today with higher interest rates, that floor that I talked about that everything prices off of, we think we're in a very good position that we're more consistently able to provide that 7% return with this structure. So again, with that said, we will periodically address an asset allocation study, relook at the figures, we look at things, but from the standpoint of the major restructuring and things that we did several quarters ago, those still hold pretty well, and we don't have any major changes that we would recommend for the asset allocation today. So, again, things that haven't worked as well as if you just take a look at that relative return for the 1-year period, that we are behind the benchmark. And if we scroll down, that 1-year column and just take a look at things, we can sort of see where that relative performance differential was coming from. And no doubt the Edgar Lomax portfolio having a tougher year in the value space. We know value stocks in general didn't do as good as growth, and you can sort of see that if you look at right below Edgar Lomax and you look at their 1-year return, their benchmark was about 11.5%. If you go down to the next couple of lines, you see the Russell 1000 growth. So that's that other side of the equation at 42%. So that just shows you the big differential you had from either being in growth or value, and then let alone how your stock selection was, or how Edgar Lomax was selecting stocks within a tough market. So they did have some challenges, some of it with bank stocks, some of it with things that were a little bit more interest rate sensitive. So in their portfolio, they have things that do have higher dividend yields, which in normal environments, that's really good. That's a dividend, it's cash that's coming in. But unfortunately, when interest rates are going up, the people that trade and value all of these things that Edgar Lomax is in, they say they look at it as an inverse relationship. If the Fed's raising interest rates, then on a short-term basis, the value of some of those stocks that Lomax has are actually going down. So again, we think we're going to start to see a leveling off of that. And again, 1 month does not a pattern make, but you can see Lomax had a pretty decent month at almost 6% for December. So, but again, on this page, at least that's going to be one of the bigger explainers of that relative performance differential for the total fund. Sue, if you want to flip forward one more page. And again, taking a look at this page, so your small cap, small, micro, mid cap in aggregate had a really good year, so almost 20% relative to that small cap index, which was at 17. So bottom line, that was adding relative value or offsetting sort of that Edgar Lomax impact. If you look at the developed international managers as a combined unit, those were almost 23% relative to the index, which was at 18%. So again, a very good year for that portion of the portfolio, not only from the perspective of you got a really nice return of 20+%, but you were also ahead of the benchmark. So that worked out really well. Emerging markets, that's the next segment. Those two managers in aggregate they gave the system a 14% return relative to an index that was just shy of 10%. So again, nice snapback in general for emerging markets. That's an area that was really out of favor. It's been out of favor for the past couple of years. We're now starting to see that come back into favor with this leveling off of interest rates. And it's also good to see your managers as a group performing and adding value over that index. To flip forward one page. And here's the global, again, from an attribution standpoint, very good nominal return, almost 17%, but relative to the Exponent's overall universe that they're looking at, this MSCI world. So that's basically all of the stocks in the world. That's US and non-US emerging. It's pretty much the entire equity opportunity set. That's the benchmark, and that's what Exponence is looking to beat. So had a little bit of a tougher year relative to the benchmark, but again, it's hard to be too critical when you have an overall market that's giving you almost 20% returns. So at least from their portfolio, and then the average market itself is over 20%. So a good contribution to the overall return of the system from a nominal basis, but there is a bit of a gap from relative performance. So one thing that we did want to bring up, I know we will have a discussion with the co-chairs regarding some scheduling for meetings for the rest of the year. But we, now that we have the custody behind us and that search and all of the moving pieces there and some other heavy lifting that's been done, we do want to get back into a rotation of having managers come in and provide updates on their portfolios. And so I think Exponence is certainly one we'd love to have in the queue, probably for some point this year, again, just to come in, spend a few minutes and talk about this portfolio. And they can also talk about their fixed income portfolio as well. So just talk a little bit about attribution, what's worked, what hasn't. Also recall that this Exponence portfolio had a little bit of this global portfolio had a little bit of restructuring from a custodial standpoint. So they restructured how all their sub custody accounts were set up. Again, a lot of that is stuff that you're not going to see in these reports. There's a lot of behind the scenes to it, but we just would like them to convey to everybody how that worked. And from our standpoint, we believe it was fairly painless. So Sue might think differently, so if she wants to jump in.
It was fine.
Great. Well, flip forward one page. Okay, so the fixed income managers, again, I'll just sort of focus on the full year, so you can see the aggregate of all fixed income managers. That's the top line, 6.5%. So again, sort of think about where we're coming from. And Bobby, this kind of goes back again to your comment on negative. So this is the one area in the portfolio where we still do see some historical negatives. So you still see the 3-year number in negative territory. And again, that's just sort of in the face of the challenging year that fixed income had last year, due to the rising interest rate scenario. Again, inverse relationship. When interest rates are going up on a short-term basis, fixed income managers are not going to do well as they reprice their portfolios. Long-term, it's good because now the world is sort of everybody now that goes out and issues new debt does it at a much higher level, so that gives us higher coupons on our bonds and our portfolio. So long-term, that's good, and you can even see how that worked out for the full 1-year period. So those are just nice fixed income returns at a level we haven't seen in quite a while. So, and again, that can really be evidenced by if you look at the 5 and 10-year numbers for all of the fixed income managers in aggregate of being just shy of 3%. So that just shows that, notwithstanding what a great year that we had this year, that a lot of other years for the past 10 in fixed income just haven't been great. Again, something we expect is much better. It looks a lot more accelerated as we go forward the next couple of years. So from the standpoint of the individual components, core fixed income at about 6.3%. That's ahead of the benchmark. So both Manulife, Earnest had very good years relative to their benchmark. If you go down to the next segment, these are the opportunistic. All of these managers are really operating more, well, with the exception of the TIPS manager. But Loomis and Neuberger are very global. So they're in U.S. fixed income, international emerging markets, and then the emerging market segment as well, at also having a nice snapback. So in general, this whole component, and again, remember a year or so ago when we addressed this component and restructured some things and said, let's kind of get rid of or minimize the risks that aren't paying us enough, and let's weight things towards the areas that we do get a better risk reward. So all of that in a structure has been working out nicely. So again, as evidenced by the group, which is at about 6.5% for the full year. Sue, flip forward one page. Okay. The global allocation, so for the full period, and this is going to be PIMCO's results, just shy of 10%. So again, nice nominal return. They do act much differently from a lot of the other managers within the portfolio. And again, recall that structure it really allows PIMCO to go anywhere and do anything. So they can be in fixed income, equities, and any segments of the world. But again, they do it on a very diversified basis, a lot of thousands of positions in that portfolio. So where they probably had their biggest miss, just they have been a little bit more cautious on equities. So relative to their benchmark, they've been underweight. And again, I kind of go back to my earlier discussion on why we try not to time the markets, but certainly in this little segment, we let the manager do that, but we do it in a very risk-controlled fashion. But this, I think that kind of goes to show that if you're a little bit cautious and you miss 2 good months like November and December, and you are underweight equity, that it can have this kind of impact that you see here. But again, as we go out longer term for a manager like PIMCO, adding value relative to that benchmark, and again, the biggest benefit of a PIMCO and even those segments below it, White Box and Grosvenor, that they're different. They're diversifiers, and they're really if you think about White Box in particular, last year had a very strong year when everything else in the portfolio was really challenged. So that's why we have these alternative pieces. Again, they're not the biggest portion. You see PIMCO at just shy of 3% of the total portfolio, and the total hedge fund allocations around 6%. So not the largest, so they don't hurt a lot when they have bad periods, but certainly they do help when the rest of the portfolio is challenged. So they're a nice, as the title for hedge funds are a hedge for the rest of the portfolio. So, and with that said, the next couple of pages, I think, are just the privates, Sue, and those are really not going to be updated for this report. So we won't see a whole lot there until the full quarterly report comes out. So, but just a couple of comments, at least on real estate. And I talked a little bit about that before, that a lot of those areas have continued to be challenged, in particular, the office space and retail. Things that have worked, that's been industrial warehouses, anybody that's kind of benefiting from the Amazon effect. So I think we all see that Amazon as a company continues to grow, and they continue to have places to put all the stuff that they're delivering to people. That's really helped that area of the real estate market. And then multifamily apartments, the demand there for first-time buyers and people that want to get out of the house and go live on their own, that demand's still been pretty good. So those areas of the real estate market have worked pretty well. But again, UBS continues to fight that battle of having a lot of that office exposure. So that's the area that just hasn't worked as well. But your other managers, BIG and Kayne Anderson and Elm Tree, they continue to focus on more niche areas, and they're sort of avoiding a lot of those other pitfall areas like office, and they're in more niche subsegments of the market that we think are going to be good, value adds for real estate as we go forward here. I will pause, see if there's any questions. Okay, Sue, I don't know if you had any handouts for just the managers. I don't think there was anything, and these are the managers that we had talked to about fees. So I will sort of talk a little bit more about good news here. And if you recall at the last meeting, we talked about 2 managers that got flagged in our quarterly reports for having fees that were above peer medians. One of those was Systematic, and we went back to them and ultimately got them to negotiate their fee down. So they brought down that first tier of their fee schedule to where I apologize, I don't have the numbers in front of me. But they came down basically on the first two tiers of their schedule, and it lowered the effective fee. So they're now going to be in line with what the peer average was.
Okay.
So we were successful on that. And again, next quarterly report, we have the full fee table in that. So we'll review that again, and everybody can see where we stand with that. And then the second was Westfield. So Westfield, basically, we went back to them and again had the conversation. They said due to most favored nations and other issues that they were unable to renegotiate their fee and bring it down. So, which sometimes they can negotiate, sometimes they can't. In this situation, we look at it and say, well, this is a manager that frankly, net of their fee, even though it's higher than the average out there, they're outperforming their index by a fair amount. So, and they've done a very good job for the system over time, even net of their fee. So we would say they've kind of earned their keep, and they've earned having that higher fee. Now, the other thing that they did mention to us is that if we were interested in going to a lower fee, that they have a mutual fund that we can move to, and that would sort of move us in line with the average fee. But there's sort of a catch to that. If we right now, this is a separately managed account, and as a separately managed account, we have the benefit of not only being able to give them specific guidelines for the portfolio and how they manage it. We kind of give up that control when we go to a mutual fund. But I think more importantly is that they are part of our diverse brokerage mandate. So that we would kind of miss out on that, because if you go to a mutual fund, we can't dictate to a mutual fund that they have to use diverse brokers. So wanted to make everyone aware of that it's kind of it's weighing a couple of issues. If we're really keyed in on a fee, then the mutual fund is an option, but we give up the MWDB mandate on brokerage. But again, I would weigh that off against the current structure that we're in, that you are able to tell them your overall guidelines for the portfolio, and you've got a portfolio that has been successful net of the current fee of outperforming a benchmark.
Jeff, in that regard, I feel confident that that's something that you have a handle on, and so if their fees are higher but their returns are above what we expect, then I guess we just have to kind of go with that at this particular juncture.
Right. We would tell you right now that there's no, we wouldn't say there should be a big push to make that switch over to a mutual fund. We would say there's enough benefits in the current structure, and throwing the cherry on top that you have a manager that's outperforming the benchmark. So
that's right.
So it's very defensible what you have here. So good news, and then average news.
Well, and I just want to say, Jeff, thanks for going out for you and Gold taking the efforts. It's really nice and refreshing to be able to get that checkup every now and then, and to make sure that our managers know that we reward loyalty, because we don't put managers up for review that often. But the longevity, the relationship, and the asset growth warrants sometimes that we're a smaller fund, so we're not going to grow into the big tier marking pricing that some other big funds can do, but that they acknowledge that we're asking, and you never know until you ask. So I appreciate it.
Great. No, that's not a problem, and certainly again that's the nice thing about having the reports and a system for being able to monitor this, that we can at least see that. And again, and we always just want to make sure that everyone understands that it's not set in stone, that if you do have something that's above an average, that it's not always bad. You just have to evaluate it and say, if they're above average on a fee, are they an above average manager? And if they are, then it's fully defensible. And for managers that are underperforming and have high fees, those are the ones we're going to dig in quite a bit more on. Again, Systematic's done fine. And as you said, Christine, I think they had a realization of that they had a very long-term relationship with the system, and they appreciate that, and that's why they were flexible. And they also understand that, as we have, more good times, and as the system continues to grow assets, that they expect they probably get more coming their way too. So. And that's all I had. Sue, I think that's all we had on the agenda, correct?
Yeah, I think that was it.
All right, thanks, Jeff. Does anyone else, Sue, do you have anything else to add for today's meeting?
Nope, that was it.
All righty, does anybody on the committee have any questions that they want to ask before we adjourn?
Yes, can I make the motion to adjourn?
Oh, absolutely. Is there a second?
A second.
It's been properly moved in second. Everyone have a great evening. I'm sorry. All those in favor, please say aye.
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 Thanks, everyone. I appreciate you making the time. Jeff, you got lucky today and got to report positive numbers. Let's see if Gwilda gets the quarterly positives.
That's right. Gwilda was being nice. Gwilda was being nice to me. That's the kind of person she says.
Yeah.
Good numbers, you go ahead and do it. So.
All right.
Well, I appreciate everyone. Have a great evening. Take
Have a
care.
good
Everybody.
evening.
Have a great weekend.
Okay, good night, everybody.
Good night.
Take care.
Thanks, Jeff.
All right. Have a good one.
Thanks a lot, Jeff.
Okay.
Bye-bye.